Welcome back. Now shifting focus to market fundamentals then. Siddharth Vora from PL Asset Management is joining in with his views. Siddharth, good morning. Thank you for joining in. I'd want to start off by asking you about the flavor of the last 2 weeks, and that has been defense. They had a very, very sharp up move towards the mid part of last year. Then they had an equally sharp fall when most of these defense names fell 30, 40, 50, even 60% from their top. And now they've started to move back at an equally fast speed over the last 2 weeks, moving back towards the record high levels as well. Do you have any exposure to this theme? And for those who do, what should they do?
I think defense, on at least the sector, the narratives have been shifting very fast from the darling sector of everyone for like 1-2 years to people launching index funds and mutual funds focused on defense to everybody saying, okay, valuations are frothy, valuations are excessive. Let's unwind the whole defense position because now order books have been built in, but their whole execution and recovery cycle is ahead of us. So I think we've seen a lot of phases for the defense sector. And in the last couple of weeks, I think the reason sector is so well positioned is, of course, uh, geopolitical stress in India. And I think irrespective of where the trade war goes or where the tariff situation evolves, the defense sector is quite protected in terms of domestic production, domestic consumption, and an elevated trigger for fresh demand. And I think the biggest two breakthroughs that have happened on the defense sector have been fastening up the whole timeline, the whole approval process of selecting products, approving products, placing the orders, getting the whole delivery timeline quicker. That is one thing. And secondly, I think the way our defense equipment has demonstrated its capability in the last 5-6 days, I think it's for the world to see and for India to also appreciate. And I think defense on overall will do pretty well. We do have, I think, 4.5-5% exposure to defense as a sector, and we are likely to bulk it up as we get better entry opportunities. But this exposure we are maintaining for the last 3 months. So I think we're well covered. People should hold on to their defense bets.
So, in a way, a structural opportunity. Siddharth, hi, morning, and thanks for joining in. This is Reema here. Let's get to your market view now. Because while you do believe markets will consolidate, your bias is a bit bearish, and you are holding on to 15 to 20% cash levels.
Right.
What is it? What are the risks that you anticipate on the horizon? And why the bearish call, the cautiousness?
So I think chaos is pretty much the new normal in the markets, whether it's chaos driven by domestic conditions, geopolitical conditions, global conditions. So rather than saying that things are looking very good, there's no uncertainty, everything is going to just fall in place. I think a lot of bad news was earlier factored in, in Jan Feb, and then some good news started getting factored in, and now there's a brand new set of bad news. I think India has recently lost its status as the only geopolitically stable large country or large market in the world. So of course that has some bearing on how we will be perceived globally. Also, we believe despite the ceasefire, things will remain on the edge for some more time. And I think the bigger negative trigger for India is, the whole tariff relaxation and the pause between US and China is going to steal that position of global relative strength from India. I think India was literally the golden market, the way things positioned over the last 30, 60 days post the tariff announcements. I think that uh, prime position is now taken away because other markets are also getting equally attractive. So I think those are some of the key reasons I feel, India is not going to be as well positioned as it was just 10, 15 days back. Many
No,
things
but
in
Siddharth,
the last 15 days.
but Siddharth, this remains a very fluid situation, right? Despite the fact that there has been a temporary tariff agreement between the US and China, there is still tariffs nonetheless. And with Donald Trump, you never know. And it might just end up happening that the things don't work out 3 months later, and then the tariffs end up going back to previous levels, and then the geopolitical situation deteriorates again in terms of the global situation between the two countries. Isn't that a risk that an investor would want to take by putting money into India, knowing that, okay, now that the situation at the border is normalized, you can go back to growth, earnings, and so on?
So I think that risk is for every investor to take across good times, bad times, because from a medium to long term, India is a fantastic story. this is just the near term, like the next couple of months could be choppy for India. I think that's more my view rather than a 3 or 5 year view. 3 or 5 year, India is a runaway market. There's no doubt about that. But from the near term, I think we could see our valuation premiums contract a bit. And given that we are already trading at, not a very cheap valuation anymore, we don't have extreme room on the upside. Mid and small caps are still trading at 15%, 15 to 20% premium to long-term averages. Large caps had gone down to 20% discount. They're now at roughly 7-8% discount. So I don't think there's meaningful upside left. FIIs were returning aggressively, but I think now whatever's changed in the last 6 days, that could also, see a change in stance. And I think that is where my near-term concern sort of stems from. And US bond yields are rising quite decisively.
So Siddharth, can you tell us how you're constructing your portfolio now? We know 15 to 20% is cash, 4.5%, 5% is defense. What else?
So I think metals, IT, both of them, we're well positioned there. I think the structure of the portfolio is have domestic focused plays which are not vulnerable to global situations, and then have domestic plays and global plays as well, which can ride the risk on if things play out well. So I think our metals and IT positions have been planted for a while. And of course, it saw a little choppiness. And now I think the global is evolving. And we were always trying to factor this tail risk, right? That if things play out well on the global front, then IT and metals should do much better than even pharma. So I think that call is now playing out the way we had intended it to. And I think it's a good 65-70% is domestic focused. Within domestic, it's high quality lenders, capital market plays, and domestic consumption. These are the three big buckets. And on the global side, we have metals and IT. And other than this, I think minor allocation to alcohol and telecommunications, defense. I think these hold side ancillary weights like 4-5% each. But the bigger focus is on the lending, capital markets, and domestic consumption, followed with IT and metals.
What are the sectors that you would want to stay away from, Siddharth, at this point of time? Does pharma feature in that? Because we still don't know what's happening on the tariff front.
We've been out of pharma for the last 3 months, and we're not turning, greatly bullish on pharma yet. I think this is now the cycle for higher beta sectors to do well, because our quantitative models are suggesting that the high beta to low beta sector spread is hugely in favor of high beta. And high beta sectors have much better valuations compared to lower beta sectors. With India inflation moderating and an interest rate environment in India also coming down, we think higher beta sectors are likely to outperform, quantitatively at least. So we are positioned on the higher beta sectors. Within the defensive also, we've chosen IT over pharma. So that's how we are currently positioned.
All right, Siddharth, thank you so much for sparing time and joining us today. Looking forward to having you more often on the platform. Siddharth Vora there of PL Capital. Now take a short break. On the other side, the management of Aurionpro Solutions joins in to discuss the road ahead for the company along with their fourth quarter results. Stay tuned.